Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. You guys know me. I'm the guy who constantly introduces the man, the myth, the legend, the person that polishes off all my rough edges, Corey Shepard. So glad that we can be here. Who is president of Sound Financial Group? I'm not introducing you well today, and I have no awesome pithy comments. I think
it was good.
I'm seriously considering coming up with some pretty serious burns to introduce you with. The reason I haven't done any of them is I know our audience likes you more than me. And it would just get us a ton of comments in how Paul should no longer be on the podcast. So I've been holding back, but as soon as you cross our audience, I'm coming for you.
Well, I don't think my tennis game could handle me polishing off all your rough edges. Like I don't have tennis elbow now, but if I was trying to do that, it's going to become so.
Well, we're excited to have everybody here today. We've got some really fun topics we're going to talk through to give you guys a quick rundown. We're going to talk a little bit about this treasure hunter who has been kept in prison and about that story and some of the story that's not fully told in the American public that applies to people's everyday finances. Then we're going to talk about a big mistake that people can make. And of course, the article is about retirees because they want retirees to click on it, but it's really something that could go wrong in any of our portfolios. And then we're going to talk a little bit about Vanguard triggering an enormous tax bill for their clients in their mutual fund offerings with no warning. So we've got some
big deal.
Indeed. All right, Corey, do you want to kick us off on our treasure hunter? Just set the stage.
You sent me this article and I was reading it and it's long, by the way. I was like, what's the point of it? Do I really have to read all of this? But it's also an intriguing story about this guy, Tommy Thompson, which cool name. He's either a superhero or another member of like the Rolling Stones that we never knew. He got a bunch of investors to pay him to go treasure. He some $12 million in the 80s to get some equipment, some robots, some ships, and go find sunken gold. And it worked.
And he found thousands of pounds of gold at the bottom of the ocean, 8,000 feet deep. But the thing that is so curious is I'm sending Corey these articles. This is a story I've been watching now for about 6 weeks. It's been out there pretty prevalently. But everything kind of has this article title. Treasure hunter still in jail after 6 years for refusing to disclose whereabouts found of the 500 gold coins found at a historic shipwreck. Now, every article almost takes the slant of like that. How could the federal government, this guy's being kept in prison long beyond contempt of court charges, all that. And it feels a little bit wrong. But then I found something in a totally separate article after digging deeper into it.
Or it feels right, because he's keeping a national treasure from everybody, literally, like the movie National Treasure.
Yeah.
Maybe, he's just cooperating with some really important historical artifact or something.
Right, which is what I kept looking for in the articles and couldn't find it until I found one that, to Corey's point, disclosed these investors. That this much longer article that Corey's talking about shows that he took this $12 million of investor money, but then his investors never saw the return from the gold that he was finding. And it's the federal investigation, all that. Yeah, is like basically he has creditors that he hasn't paid, that he ought to pay, and he's sitting in prison until he pays those creditors. And I think all the story illustrates to us, we've talked about it on the show a bunch, but is if you notice you're reading an article and you start to feel a certain way, you may find that the author is absolutely trying to make you feel that certain way to get you deeper through the article. And how quickly that just scratching beyond the surfacey headline or the first paragraph, if it matters to you. Now, this one is kind of fun because it shows the media's incomplete telling of the facts in a situation that's not necessarily about your mutual fund or it's not about some political thing. It's just about this court case that just doesn't fully disclose why it is this guy is hung up in jail and not able to get released. So that was just a fun one to whet our appetites for, let's just say, we don't need to say misinformation, but we could say missing information for sure. That happens a lot in articles. So that is just to whet our appetite. Short, sweet, but let's get on to some of these portfolio mistakes, Corey.
Yeah. So retirees often make one big mistake with bonds. Here's what to avoid. That's the title of this article. And we've Greg Iarcucci we've used before, and I want to say
we've mispronounced his name before on the show for sure.
It's been happening his whole life. So he has some really astute tips, like investors want bonds to pad the risk in their portfolio to produce more stability, but then they make the mistake of going to really risky bonds when they add bonds to their portfolio, so it's not actually doing what they hoped that they were originally doing by adding the bonds. Well, and so he says go to higher credit quality and shorter duration bonds. Great advice.
And right before that, let's talk for a moment about why that happens even in good bond funds. All of these asset managers are having to track performance. And so they're out there trying desperately to outperform some index or something else because they know many asset managers, when they're, I would say, building a portfolio in quotes, but if I had my druthers, I would say most advisors are selling the portfolio. They want to show a good back-tested return. And one cheap way to do that is to find a bond fund as a part of the portfolio that's been performing well, but just because it's performed well in the past may not mean it well in the future, because it can have long-term bonds in it that then leave you at fixed returns that are too low for the long run. And when interest rates rise, those low fixed returns tend to be devalued by the market, driving the value of your bond fund down. So there is a big temptation for bond asset managers to kind of be seduced by the siren song of longer term and lower credit quality because it boosts those historical performance rates. And if those are too low, then when advisors do their search in a program like Morningstar, they're not going to find your past returns and add you to the portfolio.
And we've talked this on the podcast before. Folks are attracted to income. They see, oh, I'm getting 6% dividends from the bonds every year. But if the portfolio is fluctuating down 3 or 4% in the year, then that's effectively offsetting those dividends. So taking distributions from your portfolio that's growing stably or taking income, it can amount to the same thing, and it can amount to a lower outcome for you, even though it looks like a bigger dividend. So here's the one part about this article that, and this is, again, watching the media very carefully, it gives good advice at the beginning of the article, and then it says, well, what bonds do you choose? And it recommends the simple approach of a Vanguard Total Bond Market Index Fund. And we looked up VBTLX.
And right there, by the way, that feels like it's probably right, especially if you're very much in the current around finance, like it's ETF, it's low cost, or it's an index, and it's Vanguard. It checks.
They were wise. They were good before, and now they're saying this. So they said this before, and now they're telling us this one. It must fit what they said before. Well, not really.
I just clicked over for the audience, so now they're looking at the portfolio composition. So why don't you walk them through it a little bit?
Well, I saw that, and I was just like, I wonder what it looks like inside of that fund. And that's just all I'm asking, or all we're asking you to do is say, oh, I wonder, just be a little curious. Click in and you can see something like 27% of the portfolio is in A and B, like 1A and B rated bonds. So not the highest credit quality. Something like 25% is in 15-year plus maturities, not the shortest. So it's not all of the portfolio, but it's really a watered down version of what he just told you in the article.
Well, and the average duration left on these bonds is 7 years with a yield to maturity of 1.7%. So do you think that over 7 years we might be entering into, I mean, heck, I think, all the major financial publications have come out that due to the inflation we faced last year, we may end up with 4 or 5 Fed rate hikes this year to tamp down inflation. And do you think that those higher fixed income rates are going to drive down your 1.7% average yield to maturity value? You bet.
Yep.
And that's also likely to have along with it, because we know we haven't had an extended downturn. We got that little bit of downturn across the COVID crisis, but we haven't in early 2020, but we haven't seen like the market's down for a year yet. Like that hasn't happened in a while. So it is coming. And when it shows up, if we have a fixed income component of our portfolio, that bond portion, and that bond portion has a negative impact to its value as a result of not interest rates, but because of the demands for these bonds in the marketplace. And we're going to talk about that a little bit in our next segment, is that other investors' behavior impacts you. So if other people rip their money out of these bond funds because they didn't expect them to go down, that can actually have undue consequences on you, the disciplined investor. So watch what's being said and what's being recommended. In Corey's case, just being curious of, well, you're recommending this fund. How does this fund stand up to all the criteria you just gave me to assess this fund? It's an incomplete, not misinformation, but certainly some missing information. Well, speaking of information,
all right, Paul. I'm especially fired up. Yeah, you're fired up about this one.
Yeah, so I actually thought we'd covered this because I have talked to so many clients about this that Corey brought up, well, we should cover the Vanguard Tax Bus. Oh, I thought we had covered it because I've been talking about it so much. Hence why Corey is prepared for me being wound up about this. So I mentioned a few minutes ago that when you're an investor in a mutual fund, your returns can actually be impacted by the behavior of your other investors. Now, why this is important is because anytime other investors sell out of a fund, that fund manager has to produce liquidity. And the production of the liquidity oftentimes will come from them selling the things that are up and not wanting to lock in losses for assets that are down. And that can create a kind of a serious tax bill for those people left behind that are still in the fund who stayed invested. That is not the same problem for the people that left. Okay. Now, that being the case,
just say that one more time. Like, you can be a long-term buy and hold investor in a mutual fund, but things that other people do, including the fund manager, can generate a tax bill to you without you having sold anything.
That's it. Yes. Thank you, Corey, for reiterating that, because that can get lost in there because we oftentimes think it's just based upon our behavior. It's based upon the turnover inside of the portfolio, which can be because they're trying to speculate, guess what stocks are going to do, or it could be because of a large movement of other investors. And we just get a great microcosm of this here. So this specifically happened. This is the article title, is the huge tax bill that came out of nowhere at Vanguard, a change that benefited big clients and left little ones holding the bag. So there's these target date funds. Some of you have used them. They work pretty effectively inside companies' 401ks. We'll even recommend our clients getting into certain target date funds to mimic the portfolio they have with us outside of their retirement plan, because it's fairly easy to know how much is equities, how much is bonds, and you just have to, if you want the same portfolio allocation like we do for our clients, then you just keep moving out which year the lifestyle fund is pointing towards. So like the 2040 fund would be good if you're one about an 80-20 portfolio, but in a few years, that would be the 2045 fund.
And of course, it coordinates well with itself. You have 2 or 3 or 4 different mutual funds in your 401k, and they may not actually be working all that well together. There may be significant overlap. So that's where a target date fund can be super useful. And also in a retirement account, this issue we're talking about doesn't so much apply because taxes only happen when you take money out of your account, no matter what you're holding. This is about folks who have put their money in non-retirement accounts into these target date funds.
Yep. And that is the thing that occurred for Vanguard here is they solved a problem for their large institutional retirement plan investors. And it created a problem for their individual, what you'd refer to as non-qualified investors, meaning individual account or joint account. But what they did basically is there's this huge amount of lifestyle fund money that Vanguard holds. Again, you pick a future date, the portfolio gets more conservative on the way there. But one of the things they did in their Vanguard's Target 2035 and 2040 funds distributed approximately 15% of their total assets as capital gains.
Oof.
So now here's why this happened. Vanguard created a new class of share that had a minimum amount that could be invested in it that was lower cost, causing an enormous amount of their institutional investors who are invested in retirement plans, so they're not tax sensitive. Sell it in one retirement plan, buy it in another one. There's no tax consequence. Yeah. But it created all these sales, and those same mutual funds are owned by individuals. And in the article, they talk about this investor that goes by the name Sitting Hawk. He said he received $550,000 in distribution in Vanguard's Target 2035 fund. So he owes 23.8% in federal tax and 4.95% in Illinois state tax, over $150,000. He asked, how could Vanguard have let this happen? Go ahead.
Yeah, he put $1.9 million into the fund in 2015 and added some more last year. So he had about 3.6 million total in the fund, but he hadn't sold any, hadn't taken any out, but he still receives this distribution because of the mutual fund structure. So he both has a tax bill and no liquidity to pay. Like he might have to sell part of his holdings in this fund to pay that tax bill.
Well, what softens some of the inefficiency in a down market when this happens because other investors sell is you also have some losses.
Right.
But see, this occurred without triggering a bunch of losses inside the portfolio, so it just stands out a lot more. If his portfolio had dropped by, 300,000 at the same time that this happened, then it wouldn't be as noticeable. And that's the environment most of these inefficiencies occur in. And it's one of the big reasons why we use an asset management firm that requires the advisors have a degree of vetting and actually coach their clients around certain things like holding in down markets.
Right.
It's the reason why the asset management firm we used was one of the only ones out there that had net inflows back in the, market debacle of 08, 09. Because it put them in the position that the investors understood and actually wanted to add money to the portfolios, not rip money out. Because if you're in that retail investment, and I think to some degree those no-load providers are actually going to be far more susceptible to this. Even in talking to one of the platforms that we use, which has an institutional side that holds registered investment advisors like us working with our clients, but then they also have a retail side. And during the downturn of the COVID pandemic, they saw enormous amounts of people moving their money out of those retail direct investor accounts. And they saw an enormous inflow of money to those accounts that had a registered investment advisor attached to them because those clients were getting coached on how to move effectively when markets were down and not just by default run away from the immediate concern, realizing that they need to invest for 20, 30 years, which doesn't mean we get to pick the good portfolio return years. It means we have to have all the 20, 30 years of portfolio returns. So,
And I think that speaks to like for me, there's no greater testament to the value of a financial advisor and investment coach is not beating the market, because the market is the market. The market gives what it gives, but to help you as efficiently as possible get what the market is giving and not beat yourself.
mm-hmm.
And that's...
Yep. When not beating yourself means not taking on more risk than what you can tolerate. Not
being in behaviors that work counterproductive to good outcomes.
Yep.
Yeah.
Yep. Those things, like, which could be anything from a spending decision to the type of tax account you would own something in, to, like this person did a great job and ostensibly saved a lot of fees on their $3.6 million not having an investment advisor.
Mm-hmm.
Fair. But I'm willing to bet if we took this $150,000 tax bill and matched it up against what he's saved in asset management expenses, that if an advisor would have been helpful to him in that, I think it would have more than washed out this tax bill.
Yeah, for sure.
But that's the trouble, is that when we don't have help and we are going down a path we're less familiar with, or in some people's cases, they felt really comfortable when they had 200,000 investments, and now that they have much more than that, it sometimes feels like, maybe I should have somebody else take a look at this. And that's what, frankly, how we meet a lot of our clients is they have outgrown their comfort with their own competence around money. And they don't need somebody to make their decisions for them. What they need is somebody to help them understand how different decisions will turn out. So if you're one of those people, don't hesitate to reach out to us. You can reach us at info@sfgway.com. You can always put a comment down below, put a review on the podcast. Of course, we will figure out how to get a hold of you, get you a copy of one of our books, as long as you leave an honest review, comment, subscribe, like, share with a friend, subscribe to the podcast on your friend's phone while they're running to the restroom if they left their phone unlocked. So for all of those reasons, Corey and I love doing this with you guys every week. We are bummed when we have a scheduling mishap that prevents us from dropping a new episode to you on a given week. But we look forward to seeing you back here next week with more knowledge to help you design and build a good life.